Comparing returns and risks. MSCI World, S&P 500, Nasdaq 100, and S&P 500 Information Technology ETFs. If you want your money to work for you, ETFs are one of the best ways to do it. But with so many options, choosing the right ETF for your goals can be a challenge. In this video, we're diving into 4 major players in the ETF world: the MSCI World, S&P 500, Nasdaq 100, and S&P 500 Information Technology. What kind of returns can you expect, and what risks are involved? Let's break it down. The returns of major ETFs. Who comes out on top? First, the good news. These ETFs have all historically delivered excellent returns, but they differ significantly when it comes to both return potential and risk. Let's break it down. MSCI World. If you want a global approach, the MSCI World is your go-to. This index includes over 1,600 companies from 23 different countries. Historically, it has delivered a real annual return, adjusted for inflation, of around 7 to 9%. That might not sound mind-blowing, but keep in mind, a globally diversified ETF carries lower risk. The maximum drawdown, the greatest loss from peak to trough, for the MSCI World was around 40%, a manageable figure for most long-term investors, especially considering its global diversification. S&P 500. You've probably heard a lot about the S&P 500, right? This index tracks the 500 largest U.S. companies and is heavily focused on the U.S. market, which makes it more volatile than the MSCI World. Historically, the S&P 500 has delivered a real annual return of around 10 to 13%. That's solid, but here's the catch. The maximum drawdown has been as deep as 50%. The S&P 500 is more volatile, but it's also more rewarding. If you can handle the ups and downs, it's a great choice. Nasdaq 100. Now, things get exciting. The Nasdaq 100 has gained a lot of attention in recent years. This index is a real growth machine, thanks to all the big tech companies like Apple, Microsoft, and Tesla. And the returns, a staggering 13 to 18% annually, making it the highest among the 4 ETFs. But here's the downside. The maximum drawdown can be huge, up to 60%, as we saw during the dot-com crash. Yes, the gains are massive, but you'll need to brace yourself for some intense volatility. S&P 500 Information Technology. If you're laser-focused on tech, the S&P 500 Information Technology ETF is for you. This one is made up of only the tech companies from the S&P 500, and these companies have been on fire in recent years. The real annual return here is an impressive 17%. But like the Nasdaq 100, it comes with a major risk, maximum drawdown of up to 60%. High reward, high risk. If you're betting on the future of tech, this ETF might be your best bet, but be prepared for some serious price swings. The bottom line. Which ETF is right for you? Let's break this down simply. MSCI World. Ideal for those who want broad diversification and a steadier, less volatile return. You'll get around 7 to 9% annual returns, and the maximum drawdown is a manageable 40%. A solid, safer bet. S&P 500. If you're comfortable taking a bit more risk and want to capitalize on the growth of U.S. companies, the S&P 500 offers 10 to 13% returns with a maximum drawdown of 50%. A classic for U.S. stock investors. Nasdaq 100. For those looking to capitalize on massive growth in the tech sector, the Nasdaq 100 offers 13 to 18% returns. But beware, the 60% drawdown is no joke. This one's for risk-tolerant investors who believe in tech's future. S&P 500 Information Technology. With a 17% real annual return, this ETF is the highest performer, but also comes with the highest risk. The 60% maximum drawdown is a significant concern, so it's perfect for those who are bullish on tech and can stomach the volatility. The power of compound interest and how you benefit from time. Let's get real for a moment. Who wouldn't want their money to grow into something substantial over time? That's where compound interest comes in. Higher returns compound over time, meaning your money grows exponentially. An ETF with 17% returns annually will grow much faster than one with 7%. That's how you build wealth. But here's the thing. Higher returns come with higher risk. The good news is, with a longer investment horizon, you can ride out the volatility. The longer you stay invested, the more likely you are to weather the market's ups and downs and ultimately benefit from the incredible returns. No matter if you're playing it safe or chasing big growth, one of these ETFs could be the perfect fit for you. Just remember, the longer you invest, the more you'll benefit from the magic of compound interest. So, which ETF fits your risk tolerance? Let me know in the comments, and if you enjoyed this video, don't forget to hit that subscribe button so you don't miss anything. Catch you in the next one.